Stocks crumble into OPEX after a hot CPI takes terminal rate expectations to 4.5%. The dollar bounces and commodities get hit, especially gold, on a big spike in real yields. All eyes will be on the FOMC this week to confirm or deny the hawkish repricing. All this and more in this week's Macro Insight. All right, guys, welcome back to Macro Insight. Today is the 20th of September, and let's have a look at these markets. So bringing up our trusty old dashboard, what have we seen? So obviously a sea of red, really. You can see the sigma adjusted moves there. Sea of red across risk assets last week after the hot CPI print that came out around about this time last week, and shocked markets, triggering a quick 5% sell-off in stocks. The dollar reversed higher and then remained kind of stable, just shy of the highs, not all the way back to the highs, but as the euro kind of seems to be clinging on to that parity level. Cable, sterling, on the other hand, remained weak. So you can see, whilst the euro was down small, you had a 1.2 sigma move, 2% move on cable. So that's kind of down there, hugging near the lows. Commodities were also weaker, especially gold on a vol adjusted basis, which was more than 1 sigma move on the week, as real yields spiked back to around 1%, 10-year US real yields. Oil also under some pressure as FEDEX profit warning kind of highlighted the global recession fears. So that whole energy space kind of staying a little bit heavy. And then yield curves flattened again as 2-year yields hit cycle highs near 4%, but the 10s and the 30s remained more muted. High yield bonds obviously also remained weak and retested. HYG, for example, retesting its June lows. So generally, you know, that is kind of going to trade on a combination of what risk assets and equities are doing, but also what bonds are doing. Bonds were kind of flattish with well, they're flattish in the long end. Obviously, they sold off in the front end, and then with equities selling off, that's not going to be a good time for HYG. Okay, so those are kind of the main moves that we saw. In terms of what we're looking at for this week, it's all about central banks, obviously. We've had the Riksbank out today. We've got the FOMC tomorrow, Bank of Japan on Thursday, Bank of England, SNB. I mean, there's just South Africa. Like, there's so many rate hikes priced for this week. It's ridiculous. I think I saw Darius on the daily briefing yesterday was saying like 500 basis points of hikes are expected this week across all the different global central banks. And then we've got Eurozone flash manufacturing and services PMI on Friday, which will obviously be looked at. In terms of sort of charts and things that kind of caught my eye and what's been going on in the macro. So obviously we've had this big spike in real yields. So you've got real yields inverted here. And, you know, generally it's quite a strong relationship with forward PEs. That's what we call the equity risk premium, right? So you're as real yields spike, you would expect PEs to come down. So, you know, therefore, you know, people are basically getting better value to buy equities and being encouraged to buy equities in a world where real yields are going higher. Obviously, the inflation print sort of came out higher than expected. And really, people are saying that's down to wages. So wage growth tracker here from the Atlanta Fed showing no signs of slowing in terms of wages. And that's kind of what's really going to keep a floor under inflation, it seems, right, in the short term. In terms of rate expectations, we've got the chart below, which kind of shows us the implied policy rate out along the curve. And so that's kind of that. A few weeks ago, that was around 380 or something, and now it's pushed all the way up to 4.5%, basically. And it's priced by the rates market to be peaking out sometime around March next year at 4.5. That's a terminal funds rate. And you can see the meeting probabilities here. We've got an 80% probability of 75 bips this week. So, you know, 18% probability of 100 bips. Personally, I don't think we're going to get 100 bips, but I'm who knows, right? But really, whether we do or not, I mean, it's kind of the aggressiveness of the pricing for November and December, and the change in that is really the thing that has kind of caught the market's attention, right? So pricing in another 100 basis points in the next 2 meetings, it looks quite hawkish and quite aggressive already, right? So I think the bar's probably quite high in terms of the press conference from Powell to come out of that even more hawkish than market pricing, but you never know. Okay, and obviously there'll be more and more questions on QT and things like that. My personal gut is that it's already priced quite a long way. If they hike 75 bips and they don't talk the market to even more hawkish pricing on this press conference, then we may get a bit of a relief rally, but that remains to be seen. Yeah. In terms of sort of positioning in stocks and things like that, you got some mixed signals really. So you've basically got data on positioning from sort of the fund manager survey at Bank of America, suggesting that everyone's very underweight. Asset allocation to global stocks is at an all-time low. And that typically tends to be a good counter indicator, right? That we're due a bit of a rally. But then on the private client side, and that's where you've got this GWIM equity percentage of AUM, that's still pretty elevated, right? So that's suggesting there's still a healthy exposure to equity from the kind of private client kind of cohort, right? And I'd consider that the slower money. So whereas you've got the faster money, which is like the professional money managers, you've got this GWIM stuff, which is just more just people sort of just parking their money for the long term, and they're still quite allocated into equities, right? So for that slow positioning to really shake out, I think you would need a full-blown crisis and a deep recession before those weightings would come down from like the 60s to maybe like something we saw back in 07, 08, closer to between 40 and 50. But you would need a prolonged downturn and a crisis where in 2008 banks were going bust, right? You'd need a real kind of a fear factor in the market to get people forced out of those long-term allocations, I believe. Okay. And then on a short-term horizon, we're entering the buyback blackout, right? So obviously buybacks have been a strong bid under the market, one of those kind of price insensitive buyers that just kind of keeps coming in. And as we're heading into earnings, we're already at kind of around 50% of companies that have entered their blackout, and that's going to keep rising as we go through towards the end of the month. So just something to be aware of, that might remove a bit of a bid from the market in the short term. Yeah. Okay. Now, if we have a little look at, what's been going on with the VIX and the vol and OPEX last week. So CPI number that kind of smashed the market. We rallied into it. We got as high as 41.50, 41.60, and then that is a beastly red candle, right? That took us down on CPI. It's one of the most dramatic moves on an economic data point that I can remember, right? It just shows that everyone was just waiting to smash the market back out again, basically, right? And no one believed in that rally. Everyone thought that rally was horseshit. And it was like they just needed an excuse to sell it again, basically, right? And that gave them the excuse. And they were pretty quick to pull the trigger. Then you had the market kind of stabilize around that 3,900 area. And then FEDEX report kind of led to more weakness, and we accelerated through. Now, I do think a fair amount of this kind of aggressiveness of this sell-off was probably helped by the kind of short gamma positioning that dealers had into last Friday, because they probably had a bunch of puts that they were short, that were 39 and below, that had nothing on them, and then all of a sudden they had to put some delta hedges on against them because they exploded in value, basically. Now, in terms of what happens next, I suspect we're not going to have a massive move until FOMC. You can see, obviously, the market bounced a bit over yesterday. Is giving a bit of it back now, but I think it's just going to kind of tread water, wait for the FOMC. Yeah. Like I said, my sense is that we were a bit oversold last week, and that was a bit exaggerated by the OPEX positioning. And so I kind of favor we probably do have a bit of a relief rally in us, provided Powell doesn't, pull out a shocker, basically. Other reasons for that are, if we look at the VIX versus the MOVE index, yes, the VIX kind of rallied, but the MOVE didn't do a lot. And the MOVE has kind of been the primary driver of cross-asset volatility, and the fact that market is a bit calmer maybe means that, you know, the VIX just needs to mean revert back down, basically. You also, a kind of interesting thing that I noticed was that fixed strike volatility on that move. So you had the VIX, you had the vol up about 3 vols in S&P 1 month, for example, but the actual fixed strike volatility was flat to down, right? So if we look at the money option 38.75 put, for example, expiring in October, you can see before, when we were up at 41.50, this orange line kind of shows you where the S&P was. The implied volatility of that option was around 24.80. We then puked from 41.50 all the way down to lows of 38.50. And that volatility was only up around 40 basis points. It did get a little bit higher, but then yesterday it got annihilated. So we found ourselves on S&P down, you know, how many 100 points, right? 200 to 300 points lower on S&P, which is a significant move. And yet fixed strike volatility is down, right, on a 5-day time frame. So even though the VIX has kind of rolled along the skew and gone higher, and the at the money vol's done the same, the fact that fixed strike vol isn't really doing anything suggests that the street isn't quite as stressed and short as we might think from the gamma models that are around there. Basically, again, you know, you need to look at what the fixed strike surface is doing to get a gauge for what positioning really looks like. And for me, it's not very consistent. A move down of that magnitude in a setup where the whole street is really short Vega on the way down. They might be short gamma on the way down, but a lot of that gamma might have expired on Friday. But if they were short dated Vega on the way down, then I think vol would have caught more of a bid, basically, right? So that is for me a bit suspect. And then spot gamma put out some interesting data about, with all the OPEX weakness that we've seen this year, if you were to look at the S&P, if you were just to be long the S&P, but close out your position the Friday before OPEX week, and then re-enter your long at the end of OPEX week, and you did that all year, you've basically performed flat on, you've had flat performance. Whereas if you've just been long the S&P the whole time, you're down 20%, right? So it's quite a significant difference in just being out of the market for OPEX. So I found that interesting. And then they look at the average weekly return into OPEX and then out of it, and suggesting that this year, I mean, you've definitely seen a big step change from previous years. And you're looking at a weekly gain potentially of 2.5% the week after OPEX, as opposed to a drop of 2% for the week of OPEX. And they're kind of explaining that sort of change because we're now in a sort of downtrending bear market. A lot of the gamma is dominated by puts, right? So we're dominated by put gamma rather than call gamma, and so they're kind of, that's how they're rationalizing, right, why we're getting that sort of price action, basically, as those puts that are providing all that gamma expire, then you get a bit of a relief rally after that, basically, right? That's whether it's true or not, who knows, but that's their thesis, basically. Yeah. So we've got, so obviously S&P was down 6%, 5-6% on the week, and I think it was exacerbated by OPEX. Vol was, like I said, vol was up a good sort of 3 points. You can see 1 month volatility up 3 points. But look at the term structure, right? The term structure is now pretty inverted. Obviously, the front end's elevated because we've got FOMC this week, so that no major surprise there. But compared to where that was a month ago and even a week ago, the curve has kind of flipped to quite a steep inversion. Skew was slightly firmer, like half a vol on the 1 month 25 delta risky, but nothing crazy, right? So skew's still yet to really catch a proper bid. So if you were of the belief that the market's got a lot more downside, and you know, I think Mr. Blonde Macro was on Blockworks recently saying that his target was 3,200 on the S&P, but that's probably not. Yeah, actually, that's in Q4, right? So 3,200 in Q4 is kind of what he's looking at. If you believe that we go that far down, then kind of protection and skew in the S&P is not bad value still, basically. It hasn't really budged much from the low end of the range, okay? If you look at the vol carry, it has flipped to negative. So you've got -5 vol points of carry there. If we go to the dashboard, you can see there's a -22% on S&P. So S&P is clearly showing us the best realized compared to implied for any of the assets that we're tracking, basically. Now, like I said, that's why I think it was exacerbated into OPEX, right? We weren't seeing quite the same ferocity of realized in the other equity assets. So I think it was exacerbated a bit by the gamma complex in the S&P. Obviously, the NASDAQ did take a shoeing as well, right? But NASDAQ and S&P are kind of same sort of market, right? So yeah, that's what I'm thinking in terms of carry. So I realized it's gone from about 18 to 30 on the S&P with those big moves, right? But really, it was just one big 4% move. Since that big 4% move, you haven't had that huge moves. So once the 4% move drops out the calculation, that realized vol is going to come smashing back down, basically, right? So I wouldn't get too excited about buying a load of gamma on S&P because it's realizing so well, because it's really very flattered by just that one move. In terms of what I've been doing, right? Obviously, the strategy compass is saying sell puts. And that was just because the strategy compass is a mean reversion model, right? So saying spot is down here near the lower Bollinger, vol is elevated, so selling puts. Now, personally, I think you're a crazy man if you're selling puts here, because, you know, if we break 3,800, which is like the current put wall on S&P, I think the positioning could get very short very quickly, especially if we head towards that 35.80 area where we know the street is short about 15, 20 yards of 30th of September options, which so you could have exactly the same sort of impact that we had last week, where you went from very short dated options worth nothing were suddenly worth a load and people had to sell into that. You could have the same thing happening. If we go below 3,800, you're going to start to put some meat on those 30th of September 36 area options, and the street's going to be forced to lean short into those, basically, right? So you could definitely have an acceleration lower if we break that sort of 3,800 level. That's kind of, for me, that feels like the trigger point where you're going to start to get much closer to those options, and they're going to have some meat on them. So if I'm obviously playing, I am playing a bit of a bounce in S&P. I suspect that is what comes once, you know, they deliver their 75 bip hike. The way I'm doing it is through these call condors. So let me show you here. So these are the call condors that I executed last week. So I've done it for the 30th of September. So the idea is I'm leaning on the fact that the street's going to get very long gamma into 30th of September if we are near 4,000, right? I'm leaning on that very large position that we're all aware of, okay, at the 4,005 strike. Now, and that's why, you know, I'm thinking I want to be earning theta if we head up there, basically. Okay, I'm not willing to commit too much premium because it's fairly low conviction, and the Fed could easily, you know, do the opposite and make the market tank, right? So I don't want to buy anything with too much premium on it or too much delta on it, basically. So that's why I've ended up with this condor. So I bought 39.50 calls to 30th of Sep. I've sold the 4,000 calls, sold the 40.50 calls, and then to condor it off, rather than spend the money to buy the 4100s back, I've just pushed it back a bit and bought the 4125s because I don't mind taking the risk of, because I don't think we're going up there, basically, right? I don't think we're really going to break 4100 by the 30th of Sep. So but I just want to cap my downside, and for margin reasons as well. That's why I've bought that. But so that's what the structure looks like, a broken wing condor. And you can see that through the passage of time, you know, as spot trades up, you see that green curve is going to basically move up towards there. So you're going to make your money. You're going to make your money if the market grinds up towards 4,000 over the next 10 days. And that's how you're going to max out and make. So you're going to be earning some really nice theta up there on that trade. But right here, the thing only cost me around $6, basically, right? It's cost me $6. If I max out, it could make me $44 between 4,000 and 4,050. And if it goes all the way to the top strike, it's going to end up losing me around $31. Okay. And if we really do smash through 4,100 in short order, and I'm actually concerned we could just keep going higher, I can probably cut this thing for a loss of a lot less than that, basically, right? So I don't think I'm going to have to take the whole hit. I mean, just look here, right? If it was an instantaneous gap higher now to 4,100, yeah, I'd be down about $10 on it or something. It'd be a negative $10, which I can live with, basically, right? So that's kind of the way that I'm fading the sort of sell-off of OPEX last week to try and play a bounce. I am obviously exposed in that if the market does bounce and then just rolls over, like bounces short term for a day or two and then gets whacked after Powell speaks again on Friday or something, and then it gets whacked, I won't be able to monetize any of this trade by then because it's a slow burner that will give me the money over the passage of those 10 days. But I'm leaning on the idea that if we do manage to rally, then that street positioning is going to kind of start to hold the market near 4,000, right? So that's kind of what I'm looking for in that trade. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.